For those of you that I haven't met, I'm Sandra Navalli. I'm the Managing Director of what's called the Tamer Center for Social Enterprise. A few thank yous, firstly, to our colleagues at the Chazen Institute for Global Business, tremendous partners in this event, and also the Tamer Center team. It really, and all the people that are behind the scenes helping us execute. It really takes a village to pull something like this off, so a lot of gratitude. Thank you. What is the Tamer Center? We focus on the mission of training the next generation of business leaders to solve social and environmental problems, but using all of the things that we teach at the business school: finance, operations, strategy, marketing, data analytics for customer insights, etc. Really, if we're going to find solutions that we can implement and scale to solve things like climate change, we need people with business skills and business perspective and the business sector working with other sectors to find solutions that are workable. So the topic for today, you're all in for a treat. This event is very much squarely at the intersection of two of our programs. One is called Capital for Good, where we look at the spectrum of capital from ESG through to traditional philanthropy. And I think there's going to be lots of different tools and things out of the toolkit of the finance sector that we're going to explore, as well as the Climate Change and Business Program, which was started around 2015. That said, you know, we've been a big fan. I had my little fangirl moment with Sarah Murray at the Financial Times. I think the Financial Times has been one of the longest mainstream business publications that's covered the intersection of climate change, sustainability, business and society for many, many years. When I was a business school student, it was compulsory reading for a global perspective. And really, you know, thank you, Sarah, for the work that you've done in mainstreaming these topics. For those of you that haven't subscribed, you get free subscription through Columbia University, so please read it. Those of you that don't know Bruce Usher, just a quick plug for his book. I'm not going to read his bio, but you should buy the book because there's bios on the back cover. But he's been, our co-director for the Tamer Center for Social Enterprise, but also a star teacher at Columbia Business School for now 18 years. I was trying to remember how long it's been, but his first class on finance and sustainability was back in 2004, the fall of 2004. His first carbon finance course, as it was then called, now called climate finance, was taught in 2009. So he's been working at this topic for many, many years and has trained so many thousands of students, many of them that are working in the climate space right now. And so, you know, really terrific testament. But, you know, Bruce, I wanted to take this public forum to say thank you. There's so much gratitude for your leadership around this program, from everything around the research ramp up, you know, faculty hiring, writing cases, writing books. You know, when there's student activists wanting the school to do more on climate change, you know, the dean calls Bruce first. So thank you to all the students who have badgered Bruce and given him a ton of work to do. So, you know, probably one of the nicest and most effective faculty colleagues that is doing work in this space. And we're very thankful and grateful. With that, I wanted to turn it over to Sarah and Bruce. Thank you again. It's been one and
Thank you. Well, it's a treat to be here on many levels, actually, because I think I probably first interviewed Bruce back in 2004. So we've got a long history together, and we've literally just discovered that we live a block away from each other, which we never knew. So, but it's also a treat to be here in these. You know, this is my first time up in this new campus, so I'm very excited to see it all. So yes, and I can see some of you clutching the book, so we need no introductions to the book. But I think, you know, what's interesting is that, you know, what Bruce has been covering is something that I've sort of mirrored in my coverage, in that I think in the early days I was really covering more kind of corporate responsibility and how it related to the corporate world. And now I've sort of converged with Bruce because I'm covering much more on the investment side. And so I love the kind of overarching theme of this book, you know, the role of investment dollars in addressing climate change, because that's really where the money is and where it needs to flow. And and this also the big theme of climate change as a means of building not only a healthy investment portfolio but a healthier world, and how we do that. And I think so it's great that Bruce has done this, and I think I'm also looking at a lot of the meaty stuff you've got in there about the different technologies, the different asset classes that, it's so complicated, the world of finance, and I think you've done a great job of sort of setting all that out for everybody. But sort of before getting into some of that, I wanted to ask a sort of personal question from somebody who's been covering this for so long, as long as I have it, but in a different way. And there are so many books out there on climate change, on climate finance. I wanted to ask you, what were you burning to say with this book that you didn't feel had already been said? What wasn't out there that you wanted to fill the gap?
So I must say, writing books is hard work. I'll be first to admit that. It's a slow, painful process. And I thought the time was right to write this book, because I think there's a fundamental misunderstanding of what's going on with climate change today. I think the general perception of climate change is that time has nearly run out, and in fact, many people have already concluded we're too late. Too late to do anything about it. They've given up. And as you pointed out, I've been working in this area for 20 years, as have you, and it's not too late. In fact, when you and I started working on this, I believe then it was too early. And as anyone who's worked in the investing field knows, being too early is the same as being wrong. And when it comes to investing in climate change, let me just explain what I mean by too early. What was it that was too early? There was nothing to invest in 20 years ago that was really going to allow us to decarbonize our global economy. And I recall really clearly reading a report on solar power roughly 20 years ago and thinking, well, this is really exciting. Well, if you added up all the solar in the world that had been built 20 years ago, it was less power than one coal plant. Why? Because it was a lousy technology. It was costly. It didn't produce much energy. And reading those first reports, I remember thinking, well, this is never going to work. This is never going to get us to where we need to go. Fast forward 20 years to today. Solar is now, and this is not coming from me, it's coming from the International Energy Agency, which is a pretty conservative outfit, the cheapest source of power nearly everywhere on the planet today. In fact, paraphrasing what they write in the reports, it's the cheapest source of power humankind has ever had. The price from 20 years ago was $5 a watt. It's now 25 cents a watt. It's now 95%. And the scale has gone from one coal plant from the beginning of time to last year 172 gigawatts. But more than 100 coal plants worth of solar was built in 1 year. 20 years ago, we just didn't have anything to invest in. Renewable energy just wasn't realistic. And forget about electric vehicles. Electric vehicle meant a golf cart 20 years ago. There was nothing to invest in that would allow us to decarbonize. Today, if you take renewable wind and solar, which are the two fastest growing and cheapest forms of power on the planet, and you add in electric vehicles, those two fundamental technologies, were they implemented at scale globally, would remove about half of all greenhouse gas emissions. That would get us about halfway to where the scientists tell us we need to go, which is zero. And the technologies for the other half are in development and being financed at an early stage. And there's a lot of risk and a lot of issues around that. And I don't want to put a lens on this that, problem solved, don't worry about climate change. And we can get more into this. The window is small and very, very tight, about 30 years. But I am less worried than I was 20 years ago, in the sense that 20 years ago, we already knew the science. We knew the science of climate change. We knew what we were facing. And frankly, we did not have the solutions.
But what was because I've been speaking to a lot of people who I've spoken to over the past decade. There's a couple of decades, and people are now like, we're kind of looking back, and what could we have been doing back then if we'd managed to accelerate things if people had listened, if there was it wasn't such a big pushback from the fossil fuel industry, could we have got further than we have now, or was the technology, as you're saying, simply not there?
There's no question we could have got further. And what was missing then, and is still missing now, is a political will to address it. So my first comments are, we can address climate change. Those technologies exist, and the capital exists, and we can go deeper into that if you wish. That doesn't mean we will address climate change. And the difference is lack of political will. And that didn't exist very well 20 years ago, and if anything today, it's weaker in the sense of international cooperation. And the irony here is we're at UNGA, UN General Assembly Week, but there's not a lot of cooperation going on, and that's the biggest challenge of all.
Yeah. And I imagine the global energy crisis is not helping, is it? With this cooperation?
That's an interesting one, Sarah, and I don't have any data to back up this statement, though I've got anecdotal information from people I've spoken to about what the energy crisis is doing, specifically around as a result of the terrible war in Ukraine and what's going on in Europe. I'm sure, as most people know, the cost of energy in Europe is skyrocketed, 10x really. And the big question is that going to slow the transition from fossil fuels to renewables, or will it accelerate it? And what I'm hearing from business leaders is it will accelerate it. And the reason for that is not the cost driver and not the climate driver, both of which that's been what has been accelerating so far. The reason is a third driver, which is energy security and independence, right? And if Europeans, if Germans and others weren't already aware of the need for energy independence, this pretty much brought it home. And the thing about renewables is renewables tend to be, we call it distributed generation. You generate it pretty much where you need it or nearby. You don't have these cross-border challenges, by and large.
I mean, it's interesting. I often wonder whether so much of this has to do with the language, is that if we had been talking about energy security 20 years ago, a lot more people would have bought into it. I think the language around saving the planet is not that helpful with a certain segment of society, because actually, as I always say to everybody, the planet will be fine. We'll be just fine, but we won't be on it.
We will be less fine. Yeah, exactly.
We will have gone. But
But your point about the language, I just want to,
Yeah.
I was talking about innovation technologies. That's why the moment to invest is now. But there's a lot of other things going on that are also driving us to invest today. One of those things is government action. So I said we're not cooperating as countries, but within countries, there's a lot going on. And here in the US, of course, we have the Inflation Reduction Act, and that's the biggest act ever passed here around climate. But again, a misunderstanding is at the state level and the local level, there's an enormous amount going on. And it's not just in, let's say, Democratic-leaning states. 38 states in America today have renewable portfolio standards or goals. Many of those states are Republican-led legislatures. Those standards are not set using the language of climate change or saving the planet, but renewable energy is very popular almost everywhere.
Yeah.
And that's an important thing to keep in mind, I think.
Yeah, no, absolutely. Well, I'd love to move on to because you talk a lot about these investment strategies, and let's bring sort of investors into the conversation now. What do you see as what is the role of investors, specifically private investors, in fixing this problem that we have?
So first of all, the role of private investors is they got to carry most of the burden here, right? And historically, governments played a big role, and development institutions and the nonprofit sector. But going forward, it's going to be mostly private capital. And the reason for that is just the scale of the need. The need is somewhere between 100 and 150 trillion over 30 years. That's a very big number. Though the private capital markets can certainly do that. The capital definitely is there. So first of all, the scale is going to be about the private markets. And secondly, because what the private markets are very good at is two things. One is investing in innovation. That's what business can be good at. And two is scaling these applications. And at the end of the day, that is what this is all about. How do we take the solutions we have and scale them globally? And that requires private capital. But in order to do so, we have to be very strategic about it. And essentially, that's what the book is about, the strategies that investors are employing to execute on that scaling of these solutions. And those strategies vary.
They vary tremendously, don't they? I mean, one of the things I wanted to talk about, because I've been doing a lot of writing on this as well, is this idea of do you divest from fossil fuels, or do you keep your fossil fuel shares? I mean, it's particularly a lot of university campuses have been following the divestment path. And then now there's a growing argument that, you should hang on to your shares. And so talk a little bit about that balance. I mean, is divestment any kind of solution?
So just a quick historical anecdote here, since we're here at Columbia University. In 2016, a group of students at the university invaded President Bollinger's office to press for divestment. And this was an interesting moment because, as far as I know, this was the first time that students had taken over the president's office since the Vietnam War. It was a pretty clever technique back then, and it was pretty effective this time too. They had, as we call Presbo. That's Presbo's office for 7 days. He wasn't thrilled about that. But in the end, it brought up the issue of divestment. And in fact, the next year, Columbia University did divest thermal coal companies. And last year, the committee that reviews these proposals, which I now chair at the university, agreed to divest, recommended to divest, agreed's the wrong word, recommended to divest oil and gas company stocks as well, with a caveat that we could continue to invest in oil and gas companies that have a credible transition plan to net zero.
Right.
There's an important caveat there. But the question you asked me, I just want to share that anecdote because we're here at Columbia, a bit of history. Essentially, does divestment help us address climate change?
Yep.
And the simple answer in my research is no. What it does do, which is very important, is it aligns our personal values with our investments. The whole divestment movement started by Bill McKibben, tremendous environmentalist and author. McKibben wrote years ago, he wrote, quote, "If it's wrong to wreck the planet, it's wrong to profit from that wreckage." Pretty hard to argue with that quote. I think I agree with him. And so if you feel strongly about climate change, that's a good reason not to invest in companies that are, the worst polluters, and that is the fossil fuel companies. In fact, there's a lot of companies you might think about that, you don't smoke, you don't like cigarettes. Why would you invest in tobacco? So the problem is, it doesn't do much to actually solve the problem. And it doesn't because if you sell, someone else bought your stock. You cannot sell without a buyer. So someone else is now holding this stock. Those are secondary shares. The company itself is not getting that capital. They're just trading shares. Third, if you look at fossil fuels, 90% of fossil fuel revenues and production of oil and gas is not in public companies. It's in private, mostly in sovereign companies, like Saudi Aramco, right? National oil companies, divestment doesn't touch them. So you're only touching the 10%. And then you're selling your shares to someone who presumably has different values and thoughts about climate change. So you've simply lost your voice. When you own shares, you get to vote. You get to pester management.
Yeah.
You're no longer show. So there's unfortunately a lot of evidence that divestment doesn't do much for climate. But I still support divestment when it aligns with your values or the values of an institution, in this case, Columbia University. And so I thought it's the right thing for us to do, but we shouldn't fool ourselves about this ability.
Right. I can't remember who said it, but I always repeat it because I think it's a great phrase. It's that you can divest your way to a green portfolio, but you can't divest your way to a greener world. So you can make your own investments squeaky clean, but that's not necessarily going to help us particularly. But are there nuances within that? Because one of, because I asked this because you'll go into a lot of these different asset classes in the book, and one of the, to me, what seems to be a huge potential that hasn't really taken off yet is debt. And there you can have some leverage because, you've got governments and huge companies who need to renew their debt, who need to, replenish their mortgage every year, if you like. And is that a leverage point where you can then come in and say, well, yes, but only if?
Well, yes, if you're an institutional investor and you move a lot of capital,
right.
but, I think that's obviously key to this. But there's an even more powerful divestment maneuver, which is fixed income is certainly better than equity. It's got more influence on companies. The even more influential way of doing this is through insurance.
Right.
When insurance companies divest, by divest I don't mean selling their shares, but refuse to insure an oil and gas company or a specific project, now you're starting to have a real impact. And the reason for that is that in most countries, it's very hard to operate without insurance. You won't get the permits. And even more so without insurance, you can't get loans. And so in many cases, that's actually a tweak that goes there. But that's a very, unless you're in the insurance industry and are able to do that, that's a very specific form of divestment.
Yeah. But and as you say, you need clout. And I think one of the challenges with the divestment versus engagement is that the engagement argument really works, but that only works if you engage and you start pushing companies. As an investor, you start pushing companies in the right way, and you have to have sufficient financial clout to do that, and means of doing it.
And it's an uphill battle.
Yeah.
And there's a long history of shareholders. Again, you can vote, you have the ability to talk to management, they have to listen to you.
Right.
But how do you get them to actually change their behavior?
Yeah.
Now, you may recall the Engine Number One story
Yes.
Recently. Engine Number One, a very curiously named, very small investment fund, what, about 100 million and
Tiny, yeah.
something tiny. And they decided to try to get Exxon to change their behavior. And they decided the way to do that was to change the composition of the board. So how does a little tiny firm change the composition of one of the biggest oil companies, one of the biggest companies in the world? By the way, has a long history of not listening to their shareholders. And the way they went about it was they started a campaign focusing not on climate change, but focusing on the implications of climate change for the oil and gas industry. And the implications are that demand's falling. Demand is going to fall. And those who are high-cost producers, those who are going around throwing money at oil and gas are going to end up losing shareholder value.
Right.
So their argument wasn't, you need to change the board because we have to save the planet,
Right.
to use your terminology. It's, you got to change the board because you're going to lose our money.
Right.
And it worked.
Yeah.
Out of 4 new directors, Engine Number One picked 3 of them.
Right. Yeah.
Miraculous.
Yeah.
Really impressive.
Yeah. Although, just to play devil's advocate here, I mean, I think it's, there was that was celebrated as a great victory. To me, I sort of feel like, well, after all this time, if that's the only one victory we have, we need to get a little bit more active.
Yeah. And I think that again, unfortunately, is further evidence that sort of a divestment strategy or even these sort of shareholder activism strategies, on the margin, and they're great stories that make people feel good. The divestment movement itself gets an awful lot of positive press and good feelings.
Yeah.
But these aren't the things that are actually going to get us where we need to go.
Well, it's sort of shifted in the other direction, because I know you talk about the sort of impact approach in the book as well. What is so that there's one side, moving away from fossil fuels, fine. What does the investment community need to do to shift us towards positive investment in all these great technologies that you say are already available?
Yeah.
But, I mean, particularly in developing countries, need the funding flows to scale them up. What are the challenges there of getting that positive investment?
I want to divide it into sort of two types, two strategies on the impact side, and then 2 different places, developed countries and emerging markets. Because the quadrant of 4, very business school, right? This is the way we think here. There are investors who they focus on products and businesses that are already commercial, and their real focus is how do you scale those. And those we call thematic impact investors. And up until just a few years ago, they were a really niche little area. There were these funds, like, many people never heard of them, DBL, and these little funds. What did DBL, it's led by an investor named Nancy Fund. She and her colleagues identified that climate change and other drivers were really going to affect some of these sectors, the energy sector, transportation, and so on. And with that lens, they got very smart about what are the changes coming and where are the companies that are on the, just about on the precipice to really scale and go commercial. They found those companies, they invested in them. One of those companies is Tesla. She was one of the first investors in Tesla. She could see that coming. So those thematic investors.
And I believe agriculture is a big thing for them as well.
Agriculture as well. She invested in some of the early solar companies like Nextracker, which did very well, and a bunch of others. So it's that thematic strategy is what are the themes that we see out there, and then how do you smartly invest? And her objective is to do very well financially, and she has. Their fund has. So how do you get more of that? Right? How do you get the big? And the answer is, you do it, you make great returns, and then they just wake up and jump in. So just in the last 2 or 3 years, pretty much every large investment manager now has a thematic fund. In fact, there was a funny day last year, July, where two of the world's biggest fund managers, Brookfield and TPG, in the morning, and I can't remember which one went first, in the morning, one of them announced the world's biggest thematic climate fund, $6 billion. Isn't this exciting? And literally that afternoon, the other one announced the world's biggest climate fund, $7 billion. They topped each other within a matter of hours. That's how you get the capital mobilized. They see an opportunity and they move into it. But a lot of these newer opportunities, it's not at the scale area yet. Still a lot of risk, a lot of uncertainty. Your traditional investment manager, they by and large cannot invest there.
No. I'm assuming that a lot of the institutional investors, it's just not of a scale for them to invest in.
It's not at this scale, and they do have a fiduciary responsibility, which means they have to maximize their returns, the risk-adjusted returns. And these technologies are very risky.
Why are they risky?
And they're risky for several reasons. First of all, the technology sometimes isn't proven out. An example that would be, say, electric airplanes. And until you really prove that technology out, you don't want to be testing that one, right? And in all seriousness, this is a potential to reduce emissions from flight, but there are a lot of challenges around it. And secondly, the time frames. Most institutional investors can't go more than 10 years. They're legally restricted, and this could take 20 years to get some of this stuff off, literally off the ground. So then you've got a different group of investors. And this is what we call these impact-first investors. And the best known one is probably Bill Gates. He's impact-first because he really wants to have impact. He fundamentally wants to address climate change. And he's really rich. And this is very important because impact-first investors are willing and able to take a below-market return. What Gates says is, we're in it for the long. They'll invest for 20 years or longer. In fact, he has invested in electric planes. He's invested in all sorts of other technologies that your traditional investor can't do. Now, why is that really important? Because as much as Bill Gates is pretty wealthy, and he's got a bunch of his friends investing with him in breakthrough energy ventures. At the end of the day, it's not that much capital. The reason why, though, it's very important is maybe he invests in 50 companies, and maybe only 5 succeed. Maybe he loses money, so what? But the ones that do succeed, what he's done is he has proven to that commercial capital, the traditional capital, there's an opportunity, go get it. And that's when your traditional capital moves in. Gates and others are what we call catalytic capital.
Right. I mean, it's a little bit like, I think, philanthropy can play that role.
It is a form of philanthropy.
It's a sort of seed funding for a future industry. And I think that the Gateses of the world they're doing it through investment, not philanthropy, but it's a similar.
It's a similar thing.
principles.
Yeah, it's actually ideally combining the best of philanthropy and the best of investment.
Right, yeah.
Together.
Yeah.
Right? And this, now, you brought up the issue of developing countries or emerging markets, and this is a very special challenge. Because when you look at what we need to do over the next 30 years and how much capital, I said 150 trillion, the capital exists, the technologies, we're halfway there, we got more coming. The path to decarbonization in the developed countries is pretty clear at this point and realistic. The path in developing countries is much harder. And the reason for that is capital is very scarce. And what capital exists is rarely able to go long term. Just think about a solar or wind project. I said a few moments ago, it's the cheapest source of power on the planet if you're willing to invest for 25 or 30 years. But if you're operating in a country where cost of capital is very high, or uncertainty is very high, and your time frame maybe is only, say, 3 to 5 years.
Not to mention that your governance may be weak.
Your governance may be weak, your rule of law, you got a lot of challenges. And so here we have a special problem, and really the biggest challenge of all. And this is the role of quasi-government institutions, the UN, the World Bank, these other, to do what we call these public-private partnerships, to work with the private sector to say, what risks are you simply unable to shoulder?
Right.
We need to work together on this.
But is part of the problem here, I mean, this is something I'm working on at the moment, is that the sort of ESG industry, which has kind of exploded after the from, I guess, 2018 onwards, really, is very risk averse. And I mean, there is, the amount of capital that's gone into ESG is enormous, but not much of it is going into emerging markets. Is ESG actually a good thing or not?
So ESG, what a topic.
Environmental social governance. It's
Yeah.
terrible. I hate acronyms, sorry, but so I better spell it out. But.
There's a lot of acronyms in this field. Environmental, social, and governance factors. It's a topic full of ironies, not because of the acronym, but because of the incredible misunderstandings around it at the moment. As you mentioned, it's exploded into this enormous industry. Depending on how you count, somewhere between 40 trillion and 100 trillion of assets are following ESG principles. What is ESG principles? ESG is very simple. When investors put capital into assets, when they buy a share or invest in a property, they evaluate that asset before making the investment, mostly on financial numbers. What is the cost of it? What is the potential return of it? What are the risks? They build models, they read about it, they talk to people, and they make a decision. All ESG is saying, do all that. And also, while you're doing that, in addition, consider what material, environmental, social, and governance factors might also affect the value of that investment. So if you're investing in a property, you'd want to know whether that property was subject to flooding and whether that flood risk was likely to increase because of climate change, for example. That's all ESG is. It's potentially, and from the research we see at the moment, it appears to be a pretty smart way of investing. It's just
done very well during the pandemic. I mean,
very well, because you're considering information that wasn't previously really thought about very closely. ESG investors appear to be smarter about their investing analysis. The problem is that just because you consider those factors and then pick those companies doesn't really do much for climate change.
I mean, it's a bit like the divestment versus engagement argument. And I mean, to what extent as well, because this is the thing I'm also very interested in with the whole ESG industry, is that the focus is almost entirely on risk management.
It is.
And none of it is, so it's on how will the environment impact my investment success. It's not how will my, what I'm investing in have an impact on the planet.
Exactly.
Do we need to, like, is there a way of shifting that focus? I mean, in this massive industry that's...
Well, here's the irony of it, which is ESG has been in the news a lot in the last literally month or two because politically it's become this hot topic that certain politicians are using it.
Woke capitalism.
Yes, this is woke capitalism. Kind of like the sound of that, actually. Woke
That's quite
capitalism.
great, isn't it?
Yeah. I'm happy to be tarred with that one. But they've got it all wrong. It's totally upside down. That's the irony of it. What they've got wrong is they're saying ESG is terrible because investors are taking the money of pension funds and unions and all these people saved up all their money, and they're going to lose it trying to save the planet. These politicians, I think, are very good politicians. They're very good at their jobs. I don't think they're good investors.
No.
Actually, I don't think they know anything
Well,
about it.
I
How much do they care
believe
about
that there was
investing?
some analysis done that Texas and Florida, who have brought in these, bans for I believe their pension funds can no longer invest in ESG. It's actually going to cost them a huge amount more in
Yes.
transaction fees because there are certain banks they can no longer go to, there are certain asset managers they can't use anymore. It's actually going to cost them money.
ESG is a smarter form of investment. Again, back, a simple analogy. If you went out and bought a house, and said, I want to just go down the basement and just see if, it's flooded down there at all, if there's any water on the floor, if the sump pump works. And I said, you're banned from going in the basement. We don't allow that in our state to check out whether or not this place, who would want, you wouldn't buy that property, you'd pay a lot less for it. That's kind of this thinking. They've got it wrong.
Yeah.
But since we're here talking about climate change, this boom in ESG investing, sadly, I don't think it's going to get us as far as we want to go on addressing the climate.
Yeah, which is a shame because there's huge amounts of funding going into it.
There's a lot of capital there.
Yeah,
That's right.
yeah. And so, I'd love to go back to your sort of sense of, and we're going to go get some questions going in a few minutes. But I wanted to go back to the beginning of the conversation because you did hinted a note of optimism there. What do you feel are our best? What are we likely? We're not going to avoid climate change; it's already happening. What are the prospects of avoiding catastrophic climate change? And what investment role is in that?
Yeah. So catastrophic climate change, in this case, I'm going to say is defined by the scientists, who I absolutely trust and believe in, a warming of more than 1.5 to 2 degrees Celsius. And they define it that way because we just don't know what happens beyond that. Things potentially get very weird. And so science is also pretty clear. In order to do that, by 2050, no later than 2070, you've got to get emissions down to 0 or net 0. So if there's still some emissions, you've got to offset that some way. And we have a lot of confidence in that. The question is, can we do that? And we first step back and look at the big story here. It's a little daunting because we spent 300 years emitting greenhouse gases, building the Industrial Revolution, followed by the Agricultural Revolution, and everything we've created, all the prosperity, the human prosperity we've created, which has been pretty extraordinary in the sense that the average human, I'm not talking about wealthy or Americans versus others, the average human on the planet is 50 times better off than the average pre-industrial revolution, when basically everyone was poor. But there's a catch, and you all know the catch. The catch is it's unsustainable. What we've built in the last 300 years is unsustainable because of greenhouse gases. So we've spent 300 years doing this. We've now got 30 years to reverse it entirely. We have to rebuild the entire global economy.
With legacy infrastructure that's very hard to fit.
And this is one of the, so what are the challenges to doing that? One is capital. The capital is there with the caveat of developing countries, very hard to mobilize there.
Yeah.
The technologies, I believe, we're half there, and I feel reasonably confident about that. I would say the challenge comes in two forms. One is, your point, we actually have to build stuff. The technical term, build stuff, right? And this is very hard to do, particularly in developed countries.
In some ways,
really
emerging markets might have an advantage in that they've got less legacy infrastructure to get rid of.
And they can that leapfrog thing and just get right to clean energy, for example. It takes years to get approval in many cases to build things, and then it gets blocked, and there's lawsuits, and there's challenges. And all for good reasons. But the reality is, if we're going to address climate change, it all has to get rebuilt. And that's a big challenge. And then the last issue, which we talked about a few minutes ago, that gives me pause, is this lack of political will. We never cooperated well as countries.
No.
The rise of nationalism, and this is a global phenomenon, is making that cooperation worse, and that's not going to help us either.
No.
So, when I get asked, will we avoid catastrophic climate change? When I get asked that question, my answer is very clear. Yes, we can. That does mean yes, we will.
Yeah. Interesting. Well, I want to get some questions in. So I think we've got some microphones around. I can't really see much in the dazzle of lights, so I'm going to leave my colleagues to choose some people with hands up, because I can't really see.
Hi, my name is Hudson Hoyle. I'm a second-year CBS student. My question, Professor Usher, is we see very frequently in the news a lot more acute risks with climate change, flooding in Pakistan, Puerto Rico, droughts, wildfires. And Ms. Murray asked you earlier about the positive investment in climate change, but we don't often talk about preserving economic loss associated with climate change. And so my question is, do you believe that investors and businesses are appropriately considering the physical and transition risks associated with climate change in our current economy? And could you maybe elaborate on your opinion?
Thank you, Hudson. And to be clear, physical risk is kind of the obvious, right? The risks of warming, flooding, wildfires, and the other results of a warming planet. The transition risks are the risks to business that come with decarbonization. So things like changing government regulations, new technologies, changing consumer demand. By the way, all of you are part of that, because younger consumers, millennials, Gen Z, are changing their buying preferences. You're also changing your employment preferences. You want to work for more sustainable companies and the like. I believe that today business is much more aware of the transition risks because they're starting to affect them today. Changing consumer norms, changing employment practices. In fact, when I talk to business leaders, the number one issue they bring up around how climate change is affecting them today is in their hiring practices, their recruiting. Basically, most of this audience is changing that. On the physical side of it, I think companies struggle with that or just avoid it. And the reason for that is most companies actually aren't facing a lot of physical risk. It's us, humans, who face it by and large. And secondly, even when they do, it's not clear what route they have for addressing it. In the book, I write about climate mitigation. How do you reduce it? Yes. What I don't write about is investing in climate adaptation.
Which we will need to do.
Which we will need to do. But today, there's very little opportunity for the private sector, and I'm writing about the private sector. There's very little opportunity to actually invest in adaptation today. That might change. That would be my next, no, it's not my next book.
Yeah, I think we've got one over there, yeah.
Hi, my name is Mary Claire. I work at Bloomberg, actually, in ESG data, so loved hearing about your perspective there. Wanted to ask, with the lack of political will, how do you solve there? Is there, a way around some of it? I know that's a loaded question, right? But can the private sector do something there? Wanted to get your take on that.
I have a couple takes. First of all, I want to just avoid the question altogether, but we're up here. We can't avoid this question. Second thing I would say is, the obvious, trite response, vote. But here's the serious response. Government doesn't pass laws in a vacuum. They pass laws, of course, to make people vote for them, but they also pass laws where they see business pressuring them, partly because of funding reasons, partly because of business reasons, employment, and everything else. And so what we actually have seen happen in the climate field is this very interesting, almost symbiotic dance between government and the business sector, where one sort of pushes ahead a bit. Government passes a bit of laws, and then business starts implementing a bunch of, say, projects. And then government goes, oh, we can do more of that because our voters like it. and it becomes a bit of a symbiotic dance. And that's what you really want to do. And for you in the audience, I think if you think about your personal carbon footprint, I think that's a good thing. I think if you think about how you vote, I think that's a really good thing. But the really important thing is neither of those. The really important thing is what you do in your place of work. Because I'm going to assume, and I think it's a fair assumption, that pretty much everyone in this room is going to be very successful in their employment career, in their career, and the organization they work for, whether it's business or government or nonprofit, that's where you can have enormous influence and really change the trajectory. At companies like Bloomberg, this is where you can really make a big difference.
Hi, Professor. Thank you for joining us today. My name is Tommy Sadikan. I'm a second-year student at CBS. You mentioned that you are now less worried than you were 20 years ago, and that we're kind of already had the technology and the means to kind of cover the first 50% of that net zero goal. What kind of does worry you now, and kind of what do you see as the next big chunk that we'll take out of that remaining 50%?
Two separate questions. What worries me is what I meant a few minutes ago, just the rise of sort of nationalism and conflict. And at the end of the, this is, as economists say, tragedy of the commons. It's a classic economic problem. The commons is our atmosphere. It's a really big commons, but it's not unlimited, and we've managed to pollute it. So then, without any cooperation, it's very hard to address. It just gets a lot harder to address it. So that worries me. What comes next on the product front? I would say there's one technology that's sort of moving from not so commercial to commercial, and that's energy storage. A lot of interesting work around lithium-ion batteries and the different formulations, different use of minerals, all sorts of interesting developments there that's taking that field sort of into the fully, it can compete with fossil fuels. What's further down the road, and in some ways much more interesting, if you're sort of looking over the horizon, is green hydrogen. Green hydrogen is the most abundant element in the universe, but it's never in in the Earth. It's never in its free form. You have to split it off something else, and the way we normally do that is splitting it from water, H2O. You take the H, but that's very energy intensive. Using very low-cost renewables. Today, renewables are getting near, in some places, down to 1 or 2 cents a kilowatt hour. For those who pay for the electric bill in New York City, it's 25 cents a kilowatt hour. So just think about how cheap that is. When it gets that cheap, we're starting to be able to split water, something called electrolyzer, and get hydrogen. Now, what do you do with this hydrogen? Well, first of all, it's emissions-free. It's green hydrogen. This is a very useful product. You can produce green steel. You can fly planes with no emissions. You can heat buildings and homes. In fact, you can solve that remaining 50%, a big chunk of that, with green hydrogen. But today it's not economic, and even more important, the infrastructure doesn't exist. The pipelines, the shipping, everything has to be rebuilt. Big opportunity.
Which is,
big
of course,
challenge.
going back to your policy question, is where I really think that's where the governments have to step in, because these things, building pipelines and things like that, that's not a good business for a private sector. And without it, we can't. And I think, there's one great example. I think it was Norway. At certain point, and procurement can be a huge deal as well. As they said, right, the government's only going to buy electric ferries. They have a lot of ferries because they've got a lot of coastline. Yeah. They didn't have any electric ferries in Norway. So guess what? Somebody built them. They're now the biggest exporter of electric. So that kind of nudge from government, and plus with the infrastructure,
That's
I
right.
think.
You get this virtuous cycle. Once you get the nudge, the investment starts to come in, the product gets better, and at some point that product just takes off because it's competitive. It's a great product.
Yeah.
Government has a really important role in that early stage.
Yeah.
Hi, my name is Leo. I'm a sustainability management student at the School of Professional Studies. I have a bit of a more general question for our students. What are the most promising careers within sustainable finance that you see for us, for example, at the interchange between renewables and hydrogen? What kind of skills should we build up in order to, succeed in those careers?
Good question. First of all, I would say that pretty much anyone in the field of finance or investing today, if they're not already starting to touch on climate-related investments, will be pretty soon. And we haven't had a chance to talk about this, but here at the business school, my colleague, actually, he's my boss, the dean, he likes to talk about the fact that he comes out of the world of data and technology. And he talks about the fact that in his world, going back 30 years, digital technologies started to change how everything was done in business. And when we look ahead the next 30 years, climate change is going to affect how all investing is done. So my short answer to you is whatever area of finance investing you're interested in, you're going to end up touching climate. More specifically, you would sort of divide it again into there's investments in commercial products that are already at scale, and it's just very, very large, low risk, low return investments. Solar farms, wind farms, things like this, very traditional. And then you've got your high risk, early stage venture type investing. And those are really different worlds. That's the way I would sort of divide it.
And I mean, it's interesting that it used to be, when I first spoke to you, I was the only person sort of reporting on all this stuff. Fortunately now all my colleagues report on it because, it's migrated out of its silo. So to your question, I mean, Bruce is right. I don't think you need to worry about what you do because every, whether you're a procurement officer or an asset manager or whatever, you're gonna be involved in this. So I think it's like you get to know your own job and how it intersects with climate.
Exactly. Yeah. Yeah. Do we have time for?
I think we've got one more. Yeah, let's do one more.
Hi, Professor Usher. Congratulations on your book, and thanks for this. This is really fun. So my line of work, I back a lot of clean tech funds who are aligned with the mission of combating climate change. And I encounter a lot of contrarian views. And I was wondering, how would you, follow up on your fear of nationalism and critics of ESG. Let me ask a direct question on that. I'm just really keen on hearing your thoughts about this. How would you respond to a growing camp of folks who would say ESG has gone into overdrive, that it's responsible or contributing to a lot of ills that we're facing? They would say the unrest in Sri Lanka because of multilateral institutions imposing so-called arbitrary, guidelines and restrictions with the aim of furthering ESG, placing Europe at the mercy of Russia because they, undermine their own energy security. Yeah. Stuff like that.
Thank you for starting about the question by saying it's a lot of fun. You have a funny idea of fun, but if this is fun, that's great. I'm having fun. And thank you for the last question. So I do get a lot of questions of this type, and to me they fall into one of two categories. There are questions that are being asked that I think are really trying to get an understanding of the actual situation. These fields are very complex. These forms of investing are pretty complex. ESG itself is very complex to do well. As our data specialist from Bloomberg will tell you, this is really hard to do. And so there are questions that come of, how do you do this? What does work? What doesn't work? What are the implications? And by the way, not all implications of any of these strategies are always positive. Right? Some people are there are losers in this transition, decarbonize. That group, I really believe it's all about sitting down and understanding where are we at, where are we headed, and why, and what is the role in that. And they may agree with the risks and returns, or they may not. But that's at the end of the day an educated decision. Then there's another group whose belief system has already predetermined that climate change is not something they wish to address. They may not believe it's real, or it's woke capitalism, or however you want to call it. And I don't have a response to someone whose belief system's already set. I don't have that expertise. Maybe I don't have that patience. The sad reality is that all of us make a lot of our decisions based on our belief system. In fact, our belief system determines what we do, and then we look for the facts to justify it. That's how we navigate our very complex role as humans. And when it comes to something like climate change, that does all of us a disservice, by the way, not just those who may be critical of ESG, but across the spectrum. We get a little bit too defined into our belief systems and aren't willing to understand everything that's going on. So that's a long answer to your question, but I do think there's a lot of misunderstandings, and I started today's apparently fun talk by mentioning why I think there's a misunderstanding about where we are in this decarbonization arc. But I also think there's a lot of belief systems that just don't believe in it, and that's a problem.
Yeah. Although, you know, I mean, I think there is a positive note. I think that in a way, that scrutiny of ESG is a sign of a market maturing, and you know, it's not, doesn't mean all ESG is terrible. It means that we're holding them to account.
Yeah, absolutely. And I am actually quite critical of ESG, but because of specific technical reasons on where I think it fails or there's challenges in the data.
Yeah. Well, I think sadly we've got to wrap up because there's lots more to be talked about here. But thank you so much for a great talk, and I hope everybody's going to read the book. And thanks for having us.
Thank you. Thank you. Thank you.